Good morning.
Hey, good morning, John. How you doing?
Very well, and you?
I'm pretty darn good. I'm ready to roll here, but why don't we wait to see if we get more than one person, huh?
Sounds good. Oh, while I have you, I sent an email to you yesterday. I'm trying to get into your accounting 110 class,
Oh,
and
okay.
I need an ad code, they say.
Oh, yeah. I can, yeah. Don't let me forget. Let me do it now if we have a moment here.
Oh, okay, perfect. Thank you.
So you're saying you're starting off with 230, then going back to 110, huh?
Well, I'm enjoying the class, and I figured if I later decide to do something like a CPA, I have to have a certain number
Yeah.
of accounting classes, so I might as well.
Yeah. Yeah. Scoop them credits up. Absolutely. You give me a moment here to do some. Oh, wait, I can do it. Be easier to do it here on this computer, not the phone. All right, hold on here.
If it's too much trouble right now, it's fine
No,
later.
no, no, no. It's right here. Okay, we're getting mighty close. And you're looking to get into the 110 class, 80007, I believe.
Yes.
Okay, 80007. Yeah, we got 20 people in that class. That's online again, right? Zooming again?
Yes. Yes, it's online.
Jesus, this Zooming stuff is awful. Here you go. You ready?
Yes.
7UJSET.
Got it. Thank you, sir.
7UJSET. Okay. Let me get back over here. And maybe it's just gonna be me and you, John. You ready to roll?
Sure.
All right, here we go. Are you a local guy, John? You from around here?
I live in the valley. I live up in Los Olivos.
Oh, where do you live in the valley?
Los Olivos.
Oh, you're up that valley. Oh, you're up
Yes.
north there, more north. I thought you were talking the San Fernando Valley. Where I used to work. Okay, here we go. All right. Let me make sure you can see the slides. Yeah, you see the chapter 4 slides, John?
Yep, I see it.
Okay, here we go. We're going to go through a lot of slides here. This is material you learn two ways: by understanding the concept, what we're trying to do, why are we trying to write these entries, and B, just practicing them a little bit and get comfortable with them, okay? So we're
Okay.
going to talk about accrual accounting concepts. Accrual accounting, that's something we've been teaching here from day one. Accrual accounting, it means the expenses and revenues, John, are recorded at the exact moment they are incurred. It has nothing to do when the cash payment is made necessarily, okay? So we're going to talk about accrual entries and adjustment. Whoops, hold on. I turned my phone off and then turned it back on when I started to go for the ad code. Okay. Accrual basis of accounting and the reasons for adjusting entries. Adjusting entries. Here's a word you don't use too much in conversation. Periodicity, I believe it's called. It's just a gap term that says that any business, any ongoing business, can be broken down into a finite period for analysis. In other words, we can decide we're going to analyze the business on a monthly basis, quarterly basis, whatever. Obviously, in the real world, companies close every month. They go through this. Okay, so the periodicity line is not that important, other than it's usually on the test in terms of a multiple choice question. So, periodicity, you break things down into a period. Huh? The accrual basis, periodicity. Companies should recognize revenue in the accounting period. They perform, match the revenues, expenses. But the right answer is the economic life of a business can be divided into artificial time periods. Accrual basis, okay? Accrual basis, recognize revenue in which the performance obligation is satisfied. In other words, you've performed the service or delivered the product. Only at that point do you recognize the revenue. And they're giving us a long-winded slide here. We'll go through a little bit. You identify the contract with the customers. You have an agreement with them. It's called a purchase order, really. And you identify what you're supposed to do in the contract, determine the price, allocate the transaction to different obligations, recognize revenue when each performance obligation is satisfied. My advice to you and to Hope, hey, good morning, Hope. Is Hope there? Maybe not.
Good morning.
Hey, good morning. You came in at a good time. We're just starting. My advice on this slide is absolutely skip it. Okay. This is just a bunch of jargon that I don't think is going to be very helpful, either in learning or preparing for the test. So I'll go on a limb with that one. Okay, here we go. Accrual basis and expense recognition. Companies recognize expenses in the period when they make the efforts to generate the revenue. In other words, when you're consuming your assets, that's turning them into an expense. Let the revenues follow the expenses follow the revenues. Okay, that makes a little bit of sense, huh? We're looking at a few more principles here. We already went over the periodicity, the revenue recognition principle. You can tell we're pounding this into you guys. Recognize revenue in the accounting period when you've done the work. Recognize expenses with the revenues in the period when the company makes efforts to generate those revenues. It means recording the electric bill in the proper month where you incurred the electric expense. Salaries and wages that were used to make that product, they go into the proper month when you experience the benefit of those expenses, if you will. Revenue and expense requisition, it's GAAP. That's basic GAAP, generally accepted accounting principles. The accrual basis of accounting, revenues recorded only. Boy, these are the questions I don't like, John and Hope, where they say which one is false, because I have a tendency of going too quickly. Which of the following is a bunch of baloney? D, revenue is recorded only when cash is received. No. Cash has nothing to do with the recording of revenues and expenses. They can occur at the same time, but that's just a timing issue. Accrual basis accounting. Wow, look at all this on accrual basis. Transactions recorded in the periods in which the events occurred. Companies recognize revenues when they perform them. Expenses are recognized when they're incurred rather than paid. And this is according to GAAP. Cash basis accounting, I'm going to skip completely. I'm going to skip any reference to cash basis accounting because cash basis accounting is not GAAP. If you try to run a business on what's called a cash basis, you're going to cash basis yourself out of business in no time. You're never going to be able to put together cogent financial statements. No one's going to loan money to you or invest in your company. Creditors will tell you to get lost. The same thing with investors. So, and more importantly, cash basis accounting is not GAAP. So no auditor is going to sign off on your business. The only people who can work with a cash business, I don't know if I mentioned this, my dear brother-in-law, he passed away sadly about 2 weeks ago, poor Artie. He and his brothers ran a gigantic auto service place in New Jersey. And they would just keep getting payments during the week for the work they did. And at the end of the week, they pretty much just emptied the cash register. And that was their salary for the week. They were clearly on a cash basis, but they could do it because they knew exactly what their flow was going to be. They knew intuitively how much cash was coming through there. But that's a real exception. Plus, they never had to borrow money or attract investors. The need for adjusting entries. Okay, adjusting journal entries can be a little tricky when you're first doing them, and we'll get a chance to practice them a little bit here. Adjusting entries are made to ensure that all the responses above are correct. So let's look at them. Adjusting journal entries are made to ensure that expenses are recognized in the right period, and so are revenues. And so that the balance sheet and income statement accounts have the correct balances at the end of the accounting period. In other words, we're going to look at a trial balance and we're going to say to ourselves, is this the right balance? And we're going to maybe say, no, it's not, because we have to add some information. And that's what the adjusting entries are about. Okay, let's take a deep breath here. Let's talk about prepaid expenses and unearned revenues. Prepaid expenses. This is your prepaid supplies and your prepaid insurance. It could be prepaid taxes. It could be a lot of different things. You buy an insurance policy on December 31st. By definition, an insurance policy just purchased is an asset. It's an asset called a prepaid expense. So you wrote a journal entry to debit prepaid expenses or prepaid insurance in this case, and you credited, let's say, cash. That's an asset. And you pay $12,000 for that insurance policy. It covers you the following year, the following fiscal year. So when you get to the end of January, you're going to expense 1/12 of that $12,000. You're then going to write a journal entry where you're going to debit insurance expense, credit prepaid insurance. Another way to say it is you're going to take these prepaid expenses and you're going to work the balances down till you get down to zero at a certain point in time. Okay? Prepaid expense. We paid in advance for something we're going to expense later. Okay? Supplies and insurance are the two examples in the book, and I think the two best examples. You see unearned revenues here. We talked a little bit about this, but let's get into this now. Unearned revenues. Unearned revenues. Cash you receive before doing anything, okay? I'm the big sports fan, right? I work for the Dodgers, and you send in your money to me, $12,000. I love $12,000 today. You send me in $12,000 for season tickets, and you did it in January. Well, the Dodgers don't play baseball January, February, or March. The season doesn't begin until April. So when the Dodgers when I got your money, when the Dodgers got your money, they debited cash and credited an account called unearned, probably unearned ticket revenue. Unearned revenue is a liability, believe it or not. Isn't that something? We just received cash. Now we have a liability to record. Yeah, you do, because you owe the people who sent in their season ticket money, you owe them baseball. So the season is 6 months long, say. At the end of April, you would take $2,000 of that $12,000 and you would record a credit to revenue, income statement revenue, and debit the liability account called unearned revenues, okay? Let me point something else out that might prove helpful in understanding. Prepaid expense, unearned revenue, the same transaction, it's the same thing. It's the same thing. It just depends what side of the equation you are. If you're the one buying the prepaid asset, you're debiting cash. If you're the one that sold the prepaid asset, you're debiting cash. Prepaid expense, you credit the cash. Unearned revenue, you're receiving the cash. It's the same thing. So the Dodgers here, in this example here, they are now going to debit cash, credit unearned revenue, and then they're going to debit that liability called unearned revenue to work it down. We're doing the same exact thing. We are going to credit the expense, the prepaid expense, the asset, and debit the expense, okay? Prepaid assets and unearned revenues are the same transaction. They're reciprocals. One is on the receiving the money side, and one is on expending the money. Accruals, we'll have a little fun with accruals in the next few slides, I hope. Accrued revenues. Revenues for services not yet received in cash or recorded. Accrued expenses are expenses incurred, but not yet paid. Let's start with accrued expenses, because that's what the bulk of this, the world is, in the world of accruals. Accrued expense. Good example, the month ends and you don't have the electric bill yet. And you know you had electricity, you know the lights were on all month, but you can't wait for the electric bill to come in 3 weeks. You have to get the statements out in 2 days. So you're going to have to accrue a number. You're going to have to look at your last month's electric bill, which was about $1,000. The month before was around $980. The month before that, it was about $1,020. So we can safely accrue a number, say, we'll be a little bit aggressive. We'll accrue $1,050, okay? You can't go too crazy. You just want to, it's got to be what they call a systematic and rational number. So accrual journal entry, we debit the expense and we credit an account called accrued payables. We debit an expense and we credit accrued payables. It could be accrued accounts payable. It could be accrued salaries if you wanted to break them out by a particular department. So accrued expenses are a big part of any company's closing. Some companies maybe are in a position where they loaned money to somebody. You guys loaned me money. You loaned me $100,000, which you're probably not going to get back, but that's beside the point. You loaned me $100,000 for 5 years. I have to pay you back in 5 years. I also have to pay interest of, let's say, $10,000 at the end of each year. So at the end of each year, if you were just doing these things once a year, you would have to say to yourself, okay, Bob owes us $10,000 in interest now, but he's not going to pay us until January 2nd. We have to pick up that revenue this period. We're going to debit interest receivable, credit interest income, okay? So you have accruals and you have the deferrals. And if I may babble a little bit more, deferral, when you see the word deferral, think of it this way. Cash changed hands, but nobody did anything. What's deferred is the service. Deferrals, cash changed hands, but nobody did anything yet. So we got to put it into a prepaid account. If we're buying it, or if we're selling the insurance, we put it into unearned revenue. An accrual account is different. There is no cash involved, no cash involved at all, but we have incurred the expense and we must come up with that number. And yes, it can be an estimated number. Again, there's an accounting term for coming up with the estimated number, systematic and rational. You just can't accrue a gigantic expense in the hope of knocking down your tax bill. It's got to be systematic and rational. And here we're looking at a good old trial balance, huh? Nice, simple trial balance. Until this point in the course, you didn't know that this trial balance by definition is wrong, okay? It's wrong because there are certain items that can only be recorded at the end of the month, okay? So let's see what we have here. We have prepaid insurance and basic things, huh? So let's keep going. Timing concepts. List of timing concepts. I don't know what they're trying to tell us here with the description. Yeah, accruals are all based on timing, obviously. When did we perform the service? When did we incur the expense versus when we get paid? Okay, so I wouldn't worry too much about that, about this slide. Maybe just glance through it a little bit. Now we get into the guts, getting right into the guts here. Hi, Gigi, how you doing?
Good morning, I'm doing good. And yourself?
The person who's late is supposed to bring cake to the meeting. Did you know that? Okay, maybe next time. Prepare adjusting entries for deferrals, okay? Hey, you remember our pile of red arrows here and how these represent the entire accounting cycle? We start with analyzing, journalize, post, and we get a trial balance. This is where we kind of cut off in the last chapter. Analyze, we got the electric bill in the mail. We look at it, it's right. We journalize it, we post a journal entry. Month end comes and we get a trial balance. Payroll. We got the payroll reports. We analyzed it. We made sure we recorded each person in their proper category. We journalized the entry. We post to the ledger, and eventually the trial balance is prepared. Now that trial balance by definition is, I'm going to use the word incorrect because it's incomplete. There are certain entries that can only be recorded at the end of the month. Things like depreciation expense, accruals you just saw, prepaids, certain things can only be done at month end. These month end journal entries are internal entries in that they don't involve an outside party. These are entries that we know we have to make here, and it just affects us internally. It has nothing to do with a customer or anything. And one golden rule with adjusting entries, you will never see the word cash in an adjusting entry. A lot of students get a little confused and they throw cash in there. Now, adjusting entries will never have the word cash. So we've gone through our analysis up to the trial balance. Now what we're going to learn here is journalizing and posting the adjusting journal entries. Let's see how clean they make this. Here we go. Prepaid expenses. Here's our first example of an adjusting journal entry. Payment of expenses recorded as an asset because the benefit is in the future. And you could have prepaid insurance, supplies, prepaid advertising. That's a classic. That's a classic where you send $10,000 to a newspaper to have them run an ad every month for the rest of the year. Rent, equipment, you can have prepaid, whatever you can think of, taxes. Prepaid expenses, okay? These prepaid expenses, these prepaid assets, expire with the passage of time via adjusting journal entries. So what we're talking about here is we have an adjusting entry where we need to debit an expense account and reduce the balance of the asset. So let's assume that we have 12,000 here as a debit in assets, prepaid asset for insurance. Our adjusting journal entry is going to be to debit insurance expense, credit adjusting entry. Sierra Company purchased supplies costing $2,500. They recorded the payment by increasing the asset supplies. This account shows a balance of $2,500. Now look what happened. The month has ended, and we've got that $2,500 sitting on our balance sheet. Well, we know that number's wrong because we know we use supplies during the month. So what we have to do now is figure out how much supplies we did use. And the way this company did it was they went out and they counted the inventory. They counted $1,000 worth of supplies. $1,000 worth of supplies. They had $2,500 to begin with, so they used $1,500. So here is your first deferred entry. You debit supplies expense and you credit the prepaid supplies. That should say prepaid supplies. I don't like them just using the word supplies. You debit the expense and you reduce the asset. And here they're kind of just showing it in different formats, huh? Analysis. The supplies expenses increased $1,500 and the asset supplies were decreased 15. And then in chapter 2, I think it was, we did some entries via just the equation, getting you familiar with the accounting equation, where we reduced the supplies. We reduced the supplies with a debit. reduce the supplies with a credit rather, and increase the expense with a debit. So our journal entry, debit supplies expense, credit prepaid supplies. Not too tough. Look what happened now to our trial balance. We had $2,500 at the end of the month. We now realize that we used 1,500 of those supplies. So we're going to credit the supplies, bringing the balance down to 1,000. The offsetting entry is a debit to an expense. Here's another tip, if I may. Think of adjusting journal entries as a search for unrecorded expenses, okay? That's pretty much what it is, with a few exceptions. So let's see what we have here. Now, here's a better example of the prepaid, because they use the word prepaid. You have insurance expense and prepaid insurance, okay? Sierra paid $600 for 1 year policy, huh? Coverage began on October 1st. They recorded the payment by debiting prepaid insurance for $600, which is correct. Okay, looks like they bought the policy in October 1st. Now the month has ended and they've gotten the benefit of 1/12 or 1 month of that policy. So now we debit insurance expense and we credit prepaid insurance, okay? Anybody have questions or anything you want to jump in? If I'm going too fast, let me know. And here they're showing it again in the different versions. But take a look at the general ledger here. We had 600 at the end of the month, October 4th. And now we know we got $50 worth of insurance coverage. That asset has been credited down to $550, and this has been debited up to $50. Search for expenses, huh? Debit expense, credit the prepaid account. And we're going to do this entry every month for the next 10 months. Next month, the balance in this prepaid accounts can go to 500, 450, 400, etc. And the expense of $600 will be spread evenly among the next 10 months. Depreciation, okay? I always tell students, this is the one you pray they put on the exam because it's the easiest. When I say it's the easiest, it's because the debit and credit is always the same. You're going to debit an account called depreciation expense and credit an account called accumulated depreciation. Buildings, equipment, things like that, big ticket items we're going to have for many years, they're recorded as assets rather than an expense. Well, you went out and you bought your sales manager a big souped up SUV for $100,000. That's clearly not an expense. That's a long-term asset. And we're going to depreciate it. Depreciation is the process of allocating the cost of an asset to expense over its useful life. Okay. Well, we paid $100,000 for this asset, and we determined that its useful life is just 5 years, because we know how our sales manager drives like crazy. He's got a big territory, so he'll easily put 65, 70,000 miles a year on this thing. We'll be lucky to get 5 years. So that'll be our basis. Depreciation does not attempt to report the actual change in the value. The depreciable entries, when you come down to the net book value, they have nothing to do with what the asset might actually be worth in the real world. Many, many, many years ago, when I was working at Thomas and Betts, before you had all the computer power you have now on PCs, we had an old printing machine which actually melted lead, believe it or not, melted lead, and then that lead was dropped into the type. You actually fill up the D, the A, the D, dad, whatever you were doing. And we would print things for people who wanted it on that printer, because using that printer and with a certain technique, we printed beautiful wanted posters, like for Westerns, if you know what I mean, the style of those. Anyway, that machine was fully depreciated before I was born. But people used to come to me and say, I'll give you 6 figures for it. On our books, it was worth 0. Now, I hope I've been gone from there for a long time. I hope they have sold it by now, because I have a feeling that machine is now worthless. You know, with the graphic arts available now, you can do anything. So take a good look at the journal entry. Depreciation expense, huh? We know what kind of an account is. That's expense. We credit accumulated depreciation, which is an asset account, but it's a contra asset account. Contra, it means that it's an outlier in that it's an asset account, but it carries a credit balance. Contra accounts, and you're going to see more and more of these as we go through 230. Contra. What did I want to say about that? Contra accounts. So you are going to take the original cost of this asset and subtract this account called accumulated depreciation to get what's called net book value. But let's go ahead here. Okay. I bring our attention down to the journal entry. Remember I said it's always the same? It's always a debit to depreciation expense and a credit to accumulated depreciation. All right. We debit depreciation expense, we credit accumulated depreciation. Here, they bought a piece of equipment for $480, and they expect this thing to last a certain number of years. Comes out $40 a month. Debit depreciation expense, credit accumulated depreciation. See the $480 they originally paid for it? After 1 month, they've depreciated 40. So the net book value is now 440. Original cost minus the balance in the accumulated depreciation account equals net book value. And that net book value is going to go down, 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 down until it reaches 0 and you're fully depreciated. Adjustment for depreciation, here it is. We bought equipment for $5,000, and now we have to take it down by $40. We're going to debit depreciation expense and credit the contra account. The contra, the asset with the credit balance. We credit accumulated depreciation. You never, never, never credit the equipment account. You never, never credit the automobile. The big, large, big ticket items, you never, never credit them, okay? So take that out of the equation right now when you're doing your homework and you're taking the test. You're never going to credit them. What is going to happen, though, is the net book value is going to go down. 5,000 minus 40, what's that? That's 49.60. Next month, we'll go down to 49.20, etc. etc. Come on. Reporting depreciation. Accumulated depreciation, a contra asset. Contra from the Spanish word meaning contra, right? The opposite. Offsets the related asset account on the balance sheet. The book value is the difference between the cost of any depreciable asset and its accumulated depreciation. So this 49.60, they're calling it book value. Typically, it's called net book value. And this is what investors are going to look at first, net book value, okay? Prepaid expenses. Now we're going to go into some more examples. Prepaid insurance, supplies, advertising, all kinds of things, huh? I see depreciation. I've never heard of prepaid depreciation, to be honest with you. But I assume our publisher knows more. Why do we have to adjust these prepaids? Because the expenses have to be recorded because we put the original cost in an asset account called the prepaids. So at this point, our assets at the end of the month are overstated and our expenses are understated. The point being, if we don't make this journal entry, if we fail to debit expense and credit the asset, accumulated depreciation, our assets are going to be overstated and our expenses are going to be understated. Of course, what that means is our net income is going to be overstated because we failed to account for this expense. So that's why we do these entries. Unearned revenue. This is the money we get in advance for something, even though we haven't done anything yet. And this is a real classic one right here. Magazine subscriptions, huh? Magazine. I subscribe to about 6 magazines, and I typically, what's the word I want? Resubscribe them in terms of maybe 2 years. So Time Magazine, for example, is $50 a year. I send in $100. That covers me for the next 2 years. When Time Magazine gets my money, what's their journal entry? They debit cash and they credit unearned revenue. Maybe they call it unearned subscription revenue. And then each week, it comes out at the rate of $1 a week. At the end of the month, it might be $5 or something. And at that point, they debit the liability unearned revenue and credit regular revenue. And what we have here is a look at the journal entry. Here is where you put the money that we received. Now we're going to reduce this liability with debit and credit regular revenue, okay? Unearned revenue is a liability. Here's some prepaid advertising, huh? We got a check in the mail for $1,200 from Arnox, and we put it into the unearned revenue account because we didn't advertise until later. So that account has a balance of $1,200. Analysis reveals that the company performed $400 worth of service. We did do $400 worth of work for this guy. So now we will credit the revenue account to increase it 400 and debit the liability account called unearned revenue to get that liability paid down, okay? And again, they have this nice grid here. And these grids I think are worth scanning through. I'm emphasizing down here what it looks like on your general ledger, okay? This is your general ledger. Here we had a balance of $1,200. We recognized $400 worth of income. We reduced this liability with a debit to the unearned account, and we credit revenues over here, okay? Service revenue. Unearned revenue, this is your stuff paid in advance, that monies we received. If we don't write this entry, if we failed to debit the liability and credit the revenues, if we failed to do it, the liabilities would be overstated and the revenues would be understated, right? So again, we would screw up the net income number. The Ledger of Hammond has these accounts. And they're talking about insurance expires, supplies on hand, depreciation. I think they're going to ask us to do some adjusting entries, okay? Okay. Here it is on your trial balance at the end of the month, $3,600. It expires at the rate of $100 per month. We bought a 3-year policy, apparently. So every month we recognize an expense of $100 and recognize that we got that benefit, and that asset is no longer worth $3,600. It's only worth $3,500. And this entry is going to be made each of the next 36 months till you get it to zero. Where I worked again, I go back to Thomas and Betts. When I worked there quite a long time, we had about 7 or 8, maybe more, prepaid accounts. And that was tricky, trying to keep up with all the, what we call the lapsing schedules on them. You know, this policy here is in the 5th month, this policy is in the 4th month, keeping them all straight for this particular journal entry. Here, we're talking about the supplies on hand. There were 2,800 on, there was 2,800 on the balance sheet, right? But how much was there at the end of the month? We went out and counted it, 800. So we used $2,000 of expense. We debit supplies expense and we credit prepaid supplies. Prepaid supplies. Here's one of our deferral type entries. Depreciation expense. It's always the same. Debit depreciation expense, credit accumulated depreciation. And they're giving you the number, $200. Here's an adjustment for unearned revenue. Unearned revenue. They're saying that of this 9,200 that we owed, we did perform enough for 4,000. We reduce that liability with a debit and we credit actual revenue, service revenue. Prepare adjusting entries for accruals. Okay, so we've gone through our grid here and we're up to the blue here, journalizing and posting journal entries. Let's take a look at it. And let me just get a little more comfortable here. Yeah, it's much better. Okay. Accrued revenues, revenue recorded before the cash receipt, right? This is a situation where we loan somebody money and they owe us rent, but they're not going to pay it till next year. Adjusting entry records the receivable and reduces the asset. Okay. Or in this case, since it's on the income side, we're going to debit an account called interest receivable and credit interest income. They perform services that were not billed to clients on the 31st. They debit accounts receivable, credit service revenue. And then when they get paid, they get paid. This is not anything to do with accruals. I think they just throw this in here to give you a quick flashback on what you learned already in the first chapter. They performed some services to be paid later. That's all. And then they got paid later. So I'm going to skip this one. Okay. Accounting for accrued revenues. You must accrue revenues because the services were performed, but we haven't yet received the cash. We loan money to somebody. So we're going to write a journal entry to debit. Since it's interest income we're awaiting, we're going to debit interest receivable and credit interest income. If we don't do this, what's going to be the problem? Assets are going to be understated, okay? Assets will be understated and revenues will be understated. We're cheating the boss of some income. Accrued expenses. Yeah, you got to accrue taxes, rent, interest, salaries, utilities, advertising, fringe benefits, salaries, a lot of stuff to accrue. Accrued adjusting entry records the obligation, recognize the expense. An accrual entry by definition is going to be, for the most part, a debit to expense and a credit to a liability. And that liability account should begin with the word accrued. Accrued salaries, accrued advertising, or just accrued payables if you don't want to detail them too much. Here's an example: accrued interest, 3-month note in the amount of $5,000. The note requires Sierra to pay interest at an annual rate of 12%. Now, let me digress just a little bit. 12%, when you see a percentage on a loan or any banking, that's 12% per year. 12% per year. 12% times 5,000 is $600. That's $600 per year interest expense, but we have to divide it by 12 to come up with 1 month, okay? A very easy mistake to make on the test is to say, oh yeah, 12% of 5,000, that's $600. That must be the answer. No, that would be if the answer was for a whole year. You got to break it down by a month. And here it is again. We debit the interest expenses increased. Okay, here we debit interest expense, credit the payable. And now they're going to lecture us about, oh, we're not getting the lecture. about what happens if we don't do it. Well, if we didn't do it, we would overstate our income and understate our liabilities. Could be a big problem. Now, here's one I bet you're all familiar with. You've all been out in the workforce, huh? And when you get paid weekly, right? But when you get your check, say on Friday, that check does not cover you till to that Friday, right? They always take a week or two back, depending on your system. So hours you work in the last week of the month need to be accrued. They need to be accrued because they're not going to be part of the journals for that month. Let's take a look at what we're talking about. Employees receive total salaries of $2,000. 5-day work week of $400 a day, okay? So the pay period looks like it goes from the 15th to for 2 weeks, and they get paid on the 26th. So this person's not going to get paid till September. What's that? I can't read it. November 9. Reaching for my glass. Okay. Let's think of it this way. This person worked on the 29th, the 30th, and the 31st. The month comes to an end. Well, there's not going to be any payroll reporting yet. You're not even going to get paid until the 9th. You get paid every 2 weeks. But when did you do the work? When did you do the work? You did the work on the 29th, the 30th, and the 31st. And they're saying it's $400 a day. I would expect to see an entry here where we debit salaries expense for $1,200. Right here, see that? Debit salaries expense $1,200. Credit the liability account called accrued salaries and wages payable. So that makes things right. At the end of the month, the company does owe you the $1,200. If you quit at the end of that day, the 31st, they have to give you your money right away. If they release you or terminate you for some reason, same thing. If the company went out of business or the building factory burned down, they would owe you that money immediately. So it's a very legitimate liability. And the expense of $1,200 belongs in the current month. The $4,000 you see here is simply the part of the payroll that was recorded. Okay. Accrued expenses. You debit an expense, credit liability, and like we just said, you don't do it, you're understating the expenses, liabilities understated. The company where I worked for a few years up here in Goleta, they were a little bit sneaky with the financials. At the end of the month, they would look at how well we did compared to budget or forecast. And I would get these pesky calls from Washington, DC, where the company was headquartered. And they said, hey, Bob, go through all of your liabilities, all your accrual accounts. Go through all the accrual accounts and be aggressive. And that was my clue. If I thought we should accrue 2,000, maybe accrue 2,500 or something. And then the next month, it might be the opposite. But companies play around with these accrual accounts quite a bit, I think. Summary of adjustments. Summary of adjustments. Prepaid assets, unearned revenues, accrued expenses. This is an excellent slide. I would mark this one and get very comfortable with it, okay? Because it really does explain what to do and why we do it. If we don't do it, everything's going to be botched up. Okay? Adjusting entries accruals. Well, let's see what they're giving us here. They're saying that the company owed its employees $800, but they're not going to be paid until September. And then this company borrowed money from a bank, so there's probably going to be interest expense to record. And we got some prepaid monies into us, some unearned revenue. Prepare the journal entry. What's going to be the journal entry for the salaries? We're going to debit salaries and wages expense and credit accrued salaries and wages right there. They borrowed $30,000 from a local bank on a 15-year mortgage. The annual interest rate is 10%. What's 10% of $30,000? That's $3,000, right? $3,000 divided by 12 is 250. They had to accrue 1 month's interest expense here. Yeah, this is just a basic entry from chapter 1. Debit accounts receivable, credit, service, revenue. That's not really an accrual entry. Okay, now we're getting toward the end here. We're going to talk about 2 more things, an adjusted trial balance and closing entries. We started off with the analyze. When we came into class today, this was the last red arrow. Now we've conquered this red arrow here, okay? And we're going to nail the next 2, the adjusted trial balance and the closing entries. Here it says this is the adjusted trial balance with adjusted accounts highlighted. Okay, well, let's see. We got supplies. Yeah, that was part of our journalizing, prepaid insurance. Yep, accumulated depreciation, unearned, salaries, interest payable, service revenue. So these are all the results after we did our journal entries, our adjustings. Adjusted trial balance review. Which of the following statements is incorrect? God, I hate that. The adjusted trial balance lists the account balance segregated by well, actually, that actually sounds fairly true to me, to be honest with you. The trial balance does go in order of assets, liabilities, capital, revenues, and expenses. Preparing the financial statements. Here we go. Financial statements come right off the adjusted trial balance. So let's see what we have here. We have a lovely completed trial balance over to the left here. And I tried, you can read the numbers. If they're too small, let me know. We got retained earnings, dividends. See the red? The red represents the income statement. Another way to say it, draw a horizontal line above the first revenue line. See what I suggested? Draw a horizontal line. Everything below that line is your income statement. Makes it easy. Everything above it is the balance sheet. So let's see what we're talking about. Well, we have revenues of 10.6. That's pretty clear, right? And then we have all these expenses. 5215, 900, 900, excuse me, 50, 40. Total expenses. Revenues minus expenses equal net income of 2860. So that's a pretty good return. That's about a 20, maybe 29% return for this guy. Sounds like a good business to me. Now that we have the income statement, we can prepare the statement of retained earnings, the retained earnings statement. We are going to start with the beginning balance of retained earnings. We're going to add the net income and subtract dividends. Turns out our beginning retained earnings was 0 because we're a new company, I guess. We add net income from here, from our income statement, 2860. But we gave out dividends of 500. We gave out these dividends of 500. So our retained earnings at the end of the month adjusted is 2,360. Now we're ready to do the balance sheet. And doing the balance sheet should be easier than falling out of a chair. You know why? Because you're copying just about every number into this into this statement here, okay? You're copying the assets, liabilities, the common stock. The only difference is you got to go back to your retained earnings statement. Oh, sorry, guys. Go to your retained earnings statement, and the retained earnings balance is now 2360. In other words, you're stepping on these numbers here. 2360, you add them down, and you're in balance, okay? Balance sheet, the only thing that's going to change from the trial balance is going to be the retained earnings number. Okay? If you can remember that, it makes life a lot easier. They're giving us a trial balance here. Okay. Determine the net income for the quarter. Yeah, I'm not sure we want to spend too much time with this, right? This is a trial balance presented out of order. And the first thing we would need to do is put this in the proper order of assets by order of liquidity, current liabilities in order of liquidity, then the capital or equity pieces, revenue, expenses. So they're asking here to put together an income statement. Well, we can quickly look at a few numbers. Here's the revenue here, 14,200. And let's see where expenses are. We got salaries, 94. We got salaries, depreciation, supplies, utility. Oh my goodness. Got about a half dozen. And there they are right there. Net income, 2490. Another lovely return for this businessman. Yeah, I'm not going to roll through this. I'm just going to bring my attention real quick. The retained earnings statement tends to scare the students a little bit. They understand the income statement easily enough, revenues minus expenses, and they understand that the balance sheet is simply a presentation of the accounting equation in that assets equal liabilities plus equity. Retained earnings, you just bide your time, okay? You start out with beginning, add the net income minus the dividends, okay? BIDE, for those people who like buzzwords, you bide your time, BIDE. On the retained earnings statement, bide. B, I, net income, D, dividends, E, ending. Some people like those kinds of things, some don't. Okay, so that was a quick buzz review of preparing the financial statements. Now we've prepared the financial statements. They've been approved. They've been published. They've been sent out to the people who need to get them, various managers of the company around the world. Banks might get them. Impossible investors get them. The public can call in and get them. So we can take a deep breath and go, oh man, took us 3 days, but we finally got done. We're done with the closing. Except for one thing, closing entries. Closing entries. Do you recall that when we brought the balance sheet over, I said one number and one number only has changed, and that was the retained earnings number. And where's the retained earnings number end up going? It goes into the balance sheet, net income and dividends. Let's take a peek here. Now, these are good grids coming up here to help you understand this, okay? Temporary and permanent accounts. The income statement, can you remember that? The income statement, temporary. They get closed to zero at the end of the month. Dividends do as well. All revenues, all expenses, all income statement items get zeroed out at the end of the month. Same thing with dividends. Permanent items are those that don't get closed. Simply means balance sheet. So you might make a note to yourself, balance sheet permanent, income statement temporary. And why are these temporaries? Because we're going to figure out what the revenue was we're going to figure out what the expenses were, and that's going to be our net income. And that net income is going to be brought over here to the stockholders' equity section. So that's part of understanding closing entries. Why we're doing them? Because we have to move the net income over to retained earnings, and it can only be done by a journal entry. Closing entries formally recognize in the ledger the transfer of net income to retained earnings, owner's drawing, or dividends. Closing entries move the net income to retained earnings and owner's drawings if you had them, okay? It produces a zero balance in each temporary account. Zero balance. You can't carry an expense balance over to the next month. That would look ridiculous. You'd have in August, you'd have 8 months worth of expenses piled up. So they have to be zeroed out every month. Generally journalized and posting only at the end of the annual accounting period. It's done at the end of every accounting period because every business of any size closes every month, okay? Prepare closing entries. So we're getting near the end, guys. This is a lot in this chapter. Prepare the closing entries. We're going to close the revenues and we're going to close the expenses. Put them in an account called income summary and then over to retained earnings. Dividends go directly to retained earnings. But let me show you. This here is an excellent screen to look at. Here's what we're doing. We're going to take every revenue account, and there could be a lot of them. This company happens to have just one, service revenue. Service revenues have a normal what kind of balance? Credit balance, right? So we are now going to debit service revenue and credit income summary. So now the income summary account has our sales information in there. We're going to do the same thing with the expenses. They have a normal debit balance, so we're going to credit each expense, debit income summary. So the balance in the income summary account now is 10,600 minus 7740. Another way to say it is that's your net income. The net income is now sitting in income summary. So those are your first two steps. Your third and fourth step, now that we have that income in income summary, we zero out the income summary and credit retained earnings. Credit retained earnings. Income summary is back to zero. You'll never see income summary on your financial statements. It's simply a clearing account. It always has a zero balance. And then we got to get rid of the dividends. Dividends reduce retained earnings. So we're going to credit dividends, debit retained earnings. So the mechanics of this is not too difficult, I don't think. As long as you know that you have to zero out the income statement and don't touch the balance sheet, basically is what we're saying. Okay. Now you go into the next month, every expense has a zero balance, which is exactly what we want to see. We don't want to layer the March expense on top of the February expense. That don't cut no ice. That's not going to be useful. No, we have to zero them out. And they're just giving you a little grid here. And this is a good one to look at. Look at all these balances, 1,500, 40 for depreciation, all of them. And what did they do? What do we do with these expenses? We credited them out. We wrote this entry here for 1,500. The balance is zero. Balance is now zero. Balance, okay. Same thing with the revenue. We get rid of that balance. We then take that 2860, or famous 2860 in net income, and we move it over to retained earnings. And we're done basically, except dividends have to be moved over to retained earnings. Although I have seen companies leave dividends in their financial statement as a minus, but typically you zero those out. Come on, come on. Hey, the summary of the accounting cycle, huh? These are the arrows. We've gone through all the arrows. We analyze business decisions and eventually come up with a post-closing trial balance. We analyze, journalize, post-trial balance, adjust the trial balance, come up with a new trial balance, use that to prepare statements, journalize posting entries, and we come up with a post-closing trial balance. By the way, the post-closing trial balance will only have balance sheet items on them. And that's a question they like to put on the test in different forms. They'll say, which of the following belongs on a post-closing trial balance? And you'll see cash, accounts receivable, inventory. Yeah, that does, right. You'll see cash, accounts payable, unearned revenue. Yeah, those are balance sheet. Then they'll show you cash, unearned revenue, and service expense. Nope. So you see that. Closing entries. Okay, they're just mixing up some accounts here. They've only got one revenue account. It looks like 98. You debit the revenue, credit income summary. You take every one of these expenses up here. I see 22, 51, and 7. You credit them out. So this company has an $18,000 net income, reduced generously by 15,000 in dividends. Dividends are not an expense, not an expense. And I believe we've come to the end of our discussion. Phew. Well, that was a long one, huh, John?
Yep.
All right. Any questions? Any comments, John?
No, I think I got it.
All right. Hey, Hope, what do you have to say for yourself? Poor Hope. Maybe she snuck out. You're on mute, Hope, if you're there. Hi, Gigi.
Oh, hi,
Hi.
sorry.
Oh, Hope, go ahead. No questions, Hope, or anything?
No questions, sorry.
Okay. Make some sense as we were going through this?
Yep.
All right. Okay, Gigi, you got a little bit late. What do you think?
I think it was really good. It's just going to take a lot of practice.
Exactly right. You just practice it a little bit, but understand the why of what we're trying to do. That's a big step. If you try to learn it just by memorizing the accounts, that makes it a little bit harder. But once you understand why we're doing these closing entries, then it'll help you out, okay? Gigi, by the way, do you want to make a motion to call the meeting?
Yeah, I motion to adjourn this meeting.
Okay, you take care, everybody. Bye-bye.
Thank you.